Hi, everyone. Welcome back. Andy Cruz here in Business Development.
And Will Flores with Mortgage Heroes.
Okay, so today was the big day. I've
day.
been talking about this for weeks. We got the Fed rate announcement coming out today. So what was the announcement today?
Well, the Fed just hiked our rates once again, Andy. I think you predicted this a few months ago.
We've been talking about it, yeah. So today the Fed came out with a 75 basis point rate hike, which is 0.75%. Now that brings the Fed funds rate to 2.5%, and it has not been that, we haven't had this steep of an increase in how long?
28 years.
So we are definitely at an unprecedented time as far as the rate of the hike accelerations or the rate hikes.
Yeah.
But we were actually at 2.5% Fed funds rate in 2019. A lot of stuff has changed since then.
Very much so.
We're going to talk about some of that today and kind of go over what we think that means for the market, how to take advantage of it, to know and be aware of what's going on, how does it affect you, and then what are some things you should be looking at on the horizon.
Yeah, and most importantly, Andy, what does this rate hike mean to you?
Yeah.
You
So
know?
let's dive into that first. So, okay, the Fed was going to come out with a rate hike of either 75 basis points. Some were calling for 100. They didn't go that hard.
Yeah.
They didn't go that hard because in their press release, they said, hey, or their press conference, they said, hey, 75 basis points is about where we need to be because we're seeing other parts of the economy that they deem strong.
Gotcha.
Now, personal opinion aside, they're right about some things and they may not be right about others. But they're citing things like labor. They're talking about people's personal profit and loss statement, that they're still cash-heavy consumer.
Yeah.
So, you see spots of that. I don't know if that's true at large for everybody because the job openings and labor turnover survey, JOLTS, still shows we have more than 11 million open jobs. So while we have really low unemployment on one side, we have a ton of openings on the other.
Correct.
So I still think there's room for that to be more clearly defined moving forward. But we're not going to hear from them again until September. So let's talk right now about what do people do. Now we got the Fed rate hike. Let's talk about what that means to the consumer.
Well, what that actually means now is the cost for getting even car loans is going to be that much higher.
Yeah.
The other thing is mortgages will be affected. We have the popular thing right now are HELOCs, home equity lines of credit. They're looking at, well, how can I consolidate some of this debt? Or I have, I want to invest into an accessory dwelling unit, which is an ADU.
Yep.
People want to do a pool right now, build a pool because it's hot, right? And so that is going to affect that, Andy. It's going to cost them more to borrow that money now. 75 basis points to be exact.
Yeah.
So car loans, credit cards, if you have those credit cards, that credit card debt and your interest rates is on an annual percentage rate, that's going to go up.
Yeah, absolutely.
So things are going to be affected for sure.
I've been talking a couple of weeks in a row at Monday Mortgage Minute. The Fed already admitted a long time ago now that their number one goal now is to tamp down inflation and get back to an inflation of only 2%. But I mean, we're in the nines. Let's not pretend like we're just close to that. We're not close to that at all.
Nines.
So what that kind of means though is that everything else in the economy is going to be at the mercy of that decision.
Yeah.
So I think we're seeing that. I still think we're going to see rate hikes in September at their next meeting, and there's probably going to be another rate hike at the end of the year too.
Yeah. So what does that mean to the consumer right now, Andy?
Well, everything's getting more expensive, right? So that's
exactly.
That's number one.
So if we
I
go,
don't think it's going to stop.
Exactly. And if we go September, they increase that again.
Yeah.
What's going to happen to those HELOCs? What's going to happen to that credit card?
It's going to slow down. I honestly think it's going to slow down. And there's a doubling effect. So it's going to slow down from the accrual of new debt because who wants to go and buy a $60,000 car or truck right now at 10%? When it was maybe only 3% or zero APY if you're going for the manufacturer, right? Okay,
not so long ago.
That's one cause and effect.
Yes.
So that's going to slow down in that particular industry. But the same can be said for the line of credit and for the credit card spending. So, there's maybe an exception for credit cards because some people may need to use their credit card just to buy gas and groceries.
Exactly.
Not like go on vacation, but actually get some of the necessities.
Yeah, pay it
and
off.
the home equity line of credit, I think there's going to be some reluctance.
Yeah.
Now, I will say, though, that you should take a hard look at that a second time if you're a homeowner with lots of equity, because we talked about this.
Yeah.
The homes have such a tremendous amount of equity that unless you put it to work,
Yeah.
it's just sitting there. And if the market ends up flattening out or does a little bit of a correction, then you're working with less equity.
Absolutely. I mean, for a lot of our homeowners, what would you do if your home value goes down? Would you be affected by that?
Some of them
Right?
will, but only if they do something about it.
That's correct. So if they're looking to do some, some things with it, this is the time to get it done. Because we already know, historically speaking, interest rates will go down again, Andy.
Yeah.
History always repeats itself. I don't know if the twos will be here, but all I know is rates will go down. The tendency is about 14, 18 months if you look at the last 15 years.
Well, and I mean, just if we step back from the whole situation for a second, you kind of look like, okay, we painted ourselves into this position, right?
Yeah.
I say we, meaning like the Fed. Okay. So we're in this situation because we're in it. This all goes all the way back to like the kickoff of the pandemic in the spring of 2020. It was like, we have to do something so that the economy as a whole just doesn't go off a cliff while we sort things out and figure it out. Okay. Well, then now I admit they're maybe a little bit late to try to cure it, but now they're going to have to go super hard for probably longer than they thought, which then they're going to have to like counter that measure with a little bit of easing, which means lower rates.
Absolutely. Well, who knows when that's going to happen?
Well, they asked that today. That actually, one of the reporters asked Jerome Powell at the press conference, and he was like,
and I'm sure they didn't answer.
Yeah, he's like,
you see, how did I predict that? We know what it is. This market is just pretty crazy on the things that are happening. This is actually one of the few times that I saw the Fed hike the rate and the actual bond market perform better.
Yes.
So these are things that before we could certainly if they raise the rates, we already know that the 10-year treasury is going to go, go bad. And so this time around, the market performed better.
It got better.
So
today.
it's like, I have a hard time understanding it.
Yeah.
Good thing I'm not Jerome Powell.
For sure. Part of the time today was spent trying to make sure that everyone understands how they're viewing whether we're in a recession or not. And that goes back to some things we've been talking about, whether they're using the technical definition or this new refined one. Okay, whatever.
Yeah.
But I think that I think there's a lot more that we don't know than we do.
Absolutely.
But as far as like moving forward, I really think this is a time where people who are already in homes have to assess like where they're at, what they're going to do next, and people that are looking to buy, then they need to make that decision. Because I think it's because the market is anticipating that we're actually at the peak, and we're only going to find that out when we're at the rearview mirror of it.
That's correct.
I think that the bond market is projecting their sentiment that we have eclipsed and met the maximum inflation that we're going to see.
Well, I tell you what, Andy, what do we do? What does a consumer do in this situation now?
Well, so if you're a home buyer, I think, you still have to have a roof over your head,
yeah.
right? So if you are a home buyer, an aspiring home buyer in 2022, you still have to go through the process. Now, if you haven't talked to us in 3 months, 4, 5, 6 months, you need to get your papers refreshed. You need to get your documents updated and your approval redone. Yeah.
But that's one of the biggest questions is now with this high interest rate environment, do I still buy? And
I still think the answer is yes.
Of course. Yeah. Well, one of the key things is if you could afford it, you buy it. It's just historically speaking, if you go back, home values always increase. It's always good to have that investment.
Yes.
And to have something. The other thing is, have you guys seen what our rents are doing?
Your rent is nuts.
Have you seen what's going on?
Rent is terrible.
I have not seen a 3-2 bedroom renting for $3,800.
Yeah.
You know what I mean? No view.
Yeah.
Right? Mm-hmm. So I think it's if you're looking at the rent or the purchase, you're not that far off.
Yeah, you're not. And it's kind of like if you're going to spend that much money, would you rather spend it on renting or spend it on a place that you're going to own and stay in for at least 5, 10, 15 years?
How much equity are you building, Andy, if you do rent?
0.
You got that right.
0. The answer is
what type
0.
of tax write-off do you get with something like that?
None.
and there it is, right? There it is. I mean, of course, it's whoever wants to get in. We'll make it happen.
Yeah, and I think that the silver lining is if we're right, and they're eventually going to have to do quantitative easing and ease the lending environment and bring more palatable rates back to the market and the bond market plays along, then I think there's going to be cheaper rates on the horizon.
I think so. One of the things, Andy, is rates are so high, but if you look at the history of it, rates have actually been at the mid 5s.
Yeah.
If you look at the graph where we've been at times, it's been at 7. Yeah. I know when I first bought my house in 2000, I was at 8.75%.
Right. I remember doing refinances in 2005, 6 at like 6%.
Yeah.
5.75. So.
And we did those too in those purchases. And next thing you know, when the rates went down, because they always do, again, history always repeats itself. Yeah. We reduced down to down in the 3.25s. Last year was in the 2s.
Yeah.
It was phenomenal.
Yeah.
So I really feel confident that history will repeat itself. I can't say when,
Yeah.
don't have that crystal ball, but I still do think get in there, take advantage of these opportunities.
Yeah.
They will be there, and just be prepared.
Yeah, those aspiring buyers need to do that. If you're an aspiring buyer, get in and hunker down. You're going to be there for a while anyway. So if you find a place you like, and especially if you're moving to a neighborhood where your kids are going to go to that elementary school, that middle school, that high school, you're in there for a long haul anyways. So at some point, you're going to pull the trigger and do it. You might as well do that now while you see more inventory coming up. There's less buyer competition happening. You're starting to see some price concessions. So right now, like the worst part of the housing scenario is the rate.
Yeah.
But everything else is starting to work more in buyer favor.
Exactly. So now let's say if you're renting, Andy, you're not looking to buy right now. What are some of the things you would recommend a person to do?
Two main things. If you're a consumer renting and you're not looking to buy this year, number one, I'd say pay down aggressively as you can any consumer debt you have. Car loans, credit cards, personal lines of credit, that kind of stuff. The other thing is save as much money as you can. So it's kind of a doubling, right? So you might need to snowball the debt payoff, but also save as much money as you can so that when the market does come around to where you want it to be, or you decide the place you want to be at, you've cleared your debt ratio will be good, and you have cash to put money down, pay for closing costs of the sellers and contributing, do upgrades right when you move in, things like that. You have maximum flexibility in that situation.
Well, that's great advice, Andy. Certainly pay down that credit card debt. Most consumers don't realize that when we sign that contract with that credit card company, it is based on APR, which is adjusted to the prime rate. So what happens is September, if they rate hike another 50 points, well, we're going to pay 50 points for that because is the bank going to cover that?
The bank always passes along the cost.
There you go. So, and that's what I tell you. Important. Pay down that debt.
Yeah.
That's the most important. And if you can't, but you have excellent credit, some of the things that I did before, because, life hasn't always been good financially for me.
Yep.
In 2010, sometimes I would borrow from Peter to pay Paul.
Yeah.
And what I would do, Andy, is because I did conserve my credit and I had excellent credit, I actually would go and apply for those zero introductory APR transfer balance. Yeah, it would cost me like 3% for that. But if my credit card was 20% on the other ones, I would just put that in there.
Yeah, that's smart.
Yeah. And so those are some of the things that I'd also recommend for somebody to do. Yeah. Why not?
That's a good idea. Yeah.
So those are great tips and great advice, Andy.
And I think it actually reveals discipline too. It's going to show you how disciplined are you in being able to do this. And I think that's helpful, especially if you're preparing to become a homeowner, where it's going to require ultimate discipline. That's a really good short-term test with a lot lower loan balance.
Yes, absolutely. Well, Andy, one of the things that I feel that I appreciate from my clients, and the reason why we're wanting to do this is because we want to give this information. Yeah. We are certainly putting ourselves in your shoes.
Yeah.
We see a lot of these things coming in. Our conversation may not be something that you're looking for, but as we speak, we hit home with a lot of other homeowners, a lot of people who are in the fence and renting right now. Yeah. So we want to make sure that we're giving this information. Yeah. We can do what most do, right?
Well, and we're in the same economy that everyone else is. Yeah. We put gas in our cars, we pay our electrical bills, we pay our other bills, we put food on the table. So we get it. We get it firsthand.
Yeah. You shouldn't pay your electric bills. You should have solar, Andy. But yeah, those are some of the things we want to do because most people don't. Yeah. And so we care. We want what's best for you. Yeah. They're your family. Yeah. That's what we said. So
good.
Okay,
well, thank you for joining Will and I again for another conversation about kind of what's going on, especially on this all-important day with the Fed rate announcement and press release. But before we go, we have an update, and we want to talk to you real quickly about Christian's Big Heart 2022.
Yes, this is actually the time of year. Once again, 5K. That's why I'm sporting it. You guys may not notice, but the left side is very different from the right side.
This is an old shirt.
Very old. This is the first shirt for Christian's Big Heart, 8 years ago. I really wish I wasn't doing this, Andy, but as you know, we care, like I mentioned earlier. Yeah. You are my friends. You are my family. So I want to make sure that we all take advantage of our heart screening that's going to be here locally in Eastlake.
Yes.
Rancho Del Rey Middle School.
Yes.
On
Sunday, August 28th.
And it'll be from 9:30 to 2:30. We're going to put a link here so that you can register if you have any friends, family members, co-workers that have children between the ages of 12 to 25.
Yes.
Bring them over. Yeah. Have them sign up
for the free heart screening.
It's free.
It's exactly why we do Christian's Big Heart, is for these free heart screenings. It's in our own backyard at Rancho Del Rey Middle. And it's also the same day that we're kicking off Christian's Big Heart 5K 2022. Correct. So we're going to have our virtual race from Sunday, August 25th, same day as the screening, all the way through September 2nd, which is Christian's birthday.
So all this month and next month, I will be wearing a T-shirt with Christian's Big Heart in his honor, all right?
I love it.
So hope to see you there. Let's continue to save lives together.
Yes.
And Andy, thank you for everything you do for us.
That is it for today. Thank you guys for watching, and we'll see you again next time.
There you go. Bye-bye.